you said that to me. You were the first person that said that to me, and I keep on using that, and I keep on not mentioning your name specifically, but I say a lady told me this, and it's like I knew it, but you framed it so well. The best investment property is one desired by owner-occupiers. That should tell you everything.
Okay. Matija.
Yes?
Great to have you here today.
Thank you. Thank you for inviting me. Thank you for flying to Sydney to do it. It must be important.
Must be. So,
But you didn't come for me though, yeah?
well, it's a combination.
Yes.
So definitely,
I'm
definitely excited to be here with you today.
Likewise.
And I know obviously that, in terms of the HtAG Analytics overall, that you shaping up or changing, let's say, the way the people go about property investment on Australian market.
Mm-hmm.
But I would love to hear it from you in terms of what do you do and who do you do it for?
It's a good question. Now, it depends how deep I need to go. So let's say if I go semi-deep, I would say that we are providing a coherent logic to understanding how the property market works. And we provide that logic through organising data, statistics and information that people can use to make a decision. So it's all about the logic. The logic comes before the actual figures on the page. And that's why I always talk about a methodology, about organising data, layering metrics to really find what you're looking for and what suits you. So I guess we're selling logic, investment logic, property investment logic. And then who do I do it for? Well, it's interesting. When we started, Alex, my co-founder, and myself, when we started the business, we actually wanted to create something for us as property investors. Because I remember at the time when we were investing in property, we used to research or search for statistics and information in the back of your investment property magazine. I don't know if you can remember, it was a long time ago. And what I figured out is that they would provide information for month, like for the month, current month, let's say days on market, vacancy rates for the current month. Then I'm like, well, it doesn't give me a good sample size for me to make a decision. I need to understand trends, So we started creating something for ourselves, and we bootstrapped from the beginning. Like we were essentially we took it seriously because we're one of these individuals that always need to have something extra to work on to keep our minds busy. But we didn't have huge intentions, so we wanted to just create something that works for us. And then as the product developed, I guess there was certain complexity that we brought forward, I guess the logic, which sort of changed people's minds. And I think that complexity gravitated more towards the professionals. So, our initial clients and most of the clients we have today are the professionals who are buying property for others on large volumes. But we also have, an investment cohort that is using the product. But I guess if I had to answer it mainly, we do it for buyers, agents and professionals who assist everyday investors, to purchase property.
Yeah, no, absolutely. But you also, a general investor can also sign up for your platform, isn't it?
Yeah. So general investors can sign up. Now, we realized that, as I said before, it's like one thing to have figures on a page and another to understand the logic and connect it into an argument. So we realized that together with the data and with the features, there needs to come some kind of mini course or some kind of an educational program, because you have different levels of understanding when it comes to data. Like when I started off and everyone else starts off, you don't know what vacancy rates are. You don't know what vacancy rates produce, inform, what they represent, etc. So investors do subscribe to our platform, which is why we created additional sort of mini courses. As you know, we have it on our mastermind platform. So there's two aspects to the service. You have the platform and then you have the mastermind community. In the mastermind community, we actually teach how people can use the data and connect the information to make a decision. Now, the learning curve can be steep for some, for others can be, not so much. So if I had to do a split, I would say, let's say 70% of our subscribers are professionals or buyers agents and 30% are investors.
But let's say, because I obviously see investor clients every day, but especially those who are first-time investors, people who want to build wealth, and many of us know there are three vehicles to build wealth, whether it's through business, shares, or real estate. Mm-hmm. And they really want to start, but they don't know where. And obviously data is, if you don't understand data or you don't know anything about it, you're shooting in the dark. Mm-hmm. And I've told you about example that we've discussed offline about, call that I've got another day
Yeah,
when
of
people
course,
just
You have to play with
buying based on the discussions that they've heard at barbecue. That is a good area to invest. What do you think are the key 5 metrics or like key data points that any investor should understand to be able to somewhat navigate the market?
Yeah, so there is an antecedent to that, to data, in a sense that people first need to understand their financial circumstance and their goals. I always say, a hammer has no intrinsic value without the carpenter.
So that's where the 4 questions
so
comes
you need to understand the brief, you need to understand what you want to buy and why, and that why corresponds to back towards an overarching strategy or a goal. For example, usually people say, I want to have 150K passive income in X amount of years, and you need to re-engineer that back or deconstruct it back to an individual brief on a purchase. Once you have that then informs the metrics that that have higher significance than others. Now, I always say not every metric is created equally under the sun, and I think this is the biggest misconception in the industry, in the data or prop tech space, is that people tend to assign the same significance to every metric under the sun.
Do you mind if I'll pause you just there? Because you've touched on something very interesting. And I've heard it said, I've heard it so many times on podcasts, but I think not everyone understands it properly in terms of re-engineering backwards. Because if you'll speak to any investor and we say, oh, you need to know what's your goal. And the answer is always, I want more money.
Exactly.
Technically. So that's where I think it's important to go deeper. And, I like those 4 questions that you've brought up in the mastermind community around what's your investment horizon, what's your budget?
Investment time horizon, equity extraction time frame, and your risk profile.
Absolutely.
And then there's a 5th one, essentially, what is your primary investment domain? It is capital growth driven or cash flow driven, or you can have a balance of 2. Now, to answer your question, we all have, you're right, we all have goals, but sometimes those goals might be might not be reasonable, and this is where the buyer's agent comes into the picture, where they can explain, well, you want 200K income, but your current cash flow, you want 200K passive income, but your current cash flow and income means or says that it will take you 35 years to get there. And this is where the buyer's agent steps in and explains what it means to get to a certain goal. But essentially deconstructing the goal back means you're either in the acquisition phase or the growth phase, or you're in the cash flow phase or maintenance phase, So everyone that starts off, depending on their age, let's say if they're younger, from 20s to 30s, depending when they start, they will be in the acquisition phase or the portfolio building phase, where their brief or the primary domain that they focus on is capital growth. And then once you reach a certain stage, we can either reconsolidate, sell off some asset, pay the rest, have the cash flow, or whether you start buying commercial property, etc., to increase that cash flow component. That will usually come after the growth phase. But to keep it simple, now deconstructing the strategy back is a complex process, but to keep it simple, you're trying to find out where the individual is now and whether they fit into the cash flow and capital growth domain primarily. And discerning where they fit into that also then informs the investment indicators or data metrics that you look at. So that's what it means deconstructing it back. You need to figure out, okay, are we acquiring property now and at what rate? Permitting serviceability, i.e., okay, how much am I earning at the moment? And even if your asset grows in value, let's say by 20 or 30%, you might not be in a position to actually extract that equity and buy additional property because your salary and the cash flow that you have now does not permit for that. So it's connecting the current individual circumstance and setting the right expectations so they understand where they can get to and for how long it will take them to do that.
Yeah, and we're in touch with you that some people probably get misled by a lot of marketing noise and so forth, that it's important to have a consistent cash flow.
Absolutely,
in order to be really successful in property.
Absolutely.
And that's where I think that little component is missing in terms of when people think that just by buying property, especially if you don't have any income or limited income, you can build a huge portfolio in a quite quick time frame, and I think it's quite misleading.
Absolutely. Now, again, you're right. We're misled by that individual who has $20 million portfolio, and we think they got to it overnight, although they might be even marketing it that way, But essentially, reduce it down to everyday behavior. I go to the bank and I say, I want to borrow money. And the first thing that they're going to ask you, what is your, how much are you earning? Can you repay the shortfall or whatever, can it cover the expense of maintaining that property and keeping that property? And when you increase the number of properties in your portfolio, it becomes, if your wages, I guess, and your income doesn't grow as well, it becomes harder to purchase new properties, which is why, as you mentioned before, people stop at 1 or 2 or 3. Now, obviously, it depends also on structures that you buy under as well, whether you buy under trusts or individuals, and there are experts out there that can talk about this much more. But your income shapes what you can afford. It's simple as that. It's, it can either be an obstruction or hurdle towards building that substantial portfolio, or you can allow you to do so. I know many individuals have, as I said, I spoke to you before and I mentioned we have a person who is one of our members and has been so for the last 2 years, and they managed to build a $5 million portfolio in 2 years from only putting the deposit down for the first property. So they used all the growth in those assets. However, they're on $500,000 wage annual, So of course they can actually do that.
Important piece of puzzle.
Yeah, exactly. The most important piece of the puzzle. Now, both pieces are important because you need that market momentum and growth to be able to generate equity that you can use to purchase other property. But at the same time, you need the serviceability or your income to supplement the extraction of that equity, So, there are two, and you're right. Usually people forget about that first component. And that's why that first component is important to be discussed when you're sitting down with a client to set the expectations. We usually talk about the end goal, and the end goal cannot be the same for all of us. Getting to 150K passive income and they always say 10 years. Some will get in 15, some in 20, some in 5. And that disparity is driven by their cash flow and their earnings.
Absolutely. And I totally agree. And I think it's just important to clarify because, I think there is some misconceptions on the property investment side. But let's go back to that 5 metrics that we've touched on.
So if you're, for example, and I'm a bit, it's hard for me to answer that question, not because I don't want to, but I want to provide an all-encompassing answer. So if as I said, your brief and financial circumstance dictates the metrics that are important. Now, we currently have 100 metrics on the platform, and I always say to people that you need to triangulate, and that's an academic term, which means essentially you need to look at every area from many different angles to understand its short-term, mid-term, and long-term appeal. So we have short-term performance, mid-term, and long-term performance. That inadvertently rearranges the metrics in that you have short-term metrics, mid-term metrics, and long-term metrics.
Let's focus on long-term, just because.
Okay, long-term metrics. Yeah.
I think long-term is kind of a low risk, the most kind of time-tested strategy.
Yeah. So again, bring it back to common sense. What are the long-term? What are the endurance and stability indicators? Now, one indicator can be past performance of the area. How volatile is the price movement of the area? We call that growth rate cycle. How much the area goes up, how much does it actually go down, what is the disparity between peak and the trough, has it lived substantial amount of years in the negative growth zone? You can compress that into one metric, the past performance and the volatility of an area. And yes, past performance is not indicative of future performance, but if you have a large enough data set that spans 20 to 30 years and you see the performance of the area, you can actually discern the area's ability to endure, the area's likelihood of stable price growth or lack thereof, Socioeconomics is also important because socioeconomics, and when I say socioeconomics, I guess socioeconomics drive the purchasing power of residents, How likely individuals, what is their capacity to actually purchase property? Again, at different time frames, because you can have great socioeconomics, but this is the third metric. If it's not combined with the right levels of affordability, if the property is very unaffordable in the area, you're creating a friction point that socioeconomics can't deal with anyway. So if you had to combine it, again, it's always a relationship between metrics. I would say the growth rate cycles that span 2.5 or 3 decades, the socioeconomics in combination with the affordability levels of the area. And then obviously another long term would be hold periods, how long do people actually retain their asset in that particular suburb? You have renter to owner ratios. Those would be, I guess I would call them as long-term metrics. Now, each one of them has a why as to why they're significant. But if you mainly want to ascertain steam and endurance, you have to combine good socioeconomics, higher levels of affordability, stable and predictive growth patterns across different timeframes, and potentially longer timeframes that longer hold period timeframes where people hold onto their property for longer in a particular suburb. But again, all of them would have also different significances on the base of what you're trying to achieve. So it all shifts. Now, it shifts. I'm not trying to say there are infinite number of permutations, but there are probably 9 and 10. Different number of variations of what carries more significance than another thing. But I guess those will be the macro factors. I guess one thing as well, sorry, I forgot to mention, risk is also very important for long term. And the way we define risk is essentially, what will stop me from realizing my goals, i.e. whether it's capital growth or cash flow. And we separate risk in 2 different domains, economic risk and environmental risk. Economic risk is usually, relational to industry diversification, while environmental risk is exposure to flooding and bushfires, for example. So those are also macro metrics. And one also metric that I consider all the time is data accuracy, especially if you're making a decision from the aspect of data. Now, data accuracy is linked to the volume of sales. The higher the volume of sales, the more predictable and discernible pattern you can extrapolate from a data set. And because property is a liquid asset, it doesn't exchange hands on a regular basis, such as shares in crypto. When you have a discernible pattern established, you can infer that will continue into the future. It will sort of endure X amount of years into the future. So data accuracy is very important. High volume of sales in a particular suburb.
So basically, we're talking high volume of sales, and that's why those kind of more smaller, remote locations can be a bit dangerous because the data can be slightly misleading because it's based on the 2 sales only.
Correct. So if you have 2 sales in 3 months.
In growth rate cycle, especially in terms of the trajectory as well, how long it's been in a negative growth zone.
Correct.
Then socioeconomics in terms of and how affordable it is for the local residents.
Yeah, socioeconomics, affordability.
And whole period, like how much people love living there.
Correct. It's a livability factor.
Do they love to stay in that area, or they live in 4 or 5 years and see you later? And the risk, right? Economic risk. And when we'd say...
I said environmental risk.
And environmental.
So economic risk would be highly centralized industries because they're prone to large fluctuations in pricing when macroeconomic conditions change, like dominance of mining and agriculture, but it can be other sectors as well. And then you have the environmental risk. Environmental risk is important because it increases your holding cost, but it's also positions a suburb as less appealing to investors. And in order for you to see above average and substantial growth across different timeframes, you need 2 cohorts competing for the same asset. So you need the owner-occupier cohort and the investor cohort competing for the same asset, which is what a supply and demand is, and that's when you see substantial price growth. So if you have an area that is dramatically exposed to flooding and bushfires, investors don't want to go into that area because it increases their holding costs substantially.
Especially for long-term investment.
Correct, yeah. It increases their holding cost, which means that it lowers their yield. And if they're not, responsive to the area, you're diminishing one purchasing cohort dramatically. So you're actually eliminating, essentially one competition side.
For sure. And I actually would add one more there that I believe is quite critical to look out for, and it's the percentage of renters.
Yeah, I said rent-to-owner ratio.
Did you? Sorry,
I mentioned it. Yeah, I mentioned it. Yeah.
Because I find that this is very often overlooked.
Yep.
And that's where those dramatic situations where all investors flood into one area.
Yeah.
And at some point, if the area cools down, that's when we see dramatic declines, especially in the interest rate increasing environment.
That's right.
When investors let it go.
So that's a great point. I always say to people that they need to understand what each data point, what kind of behavior does it represent on the ground. Every data point is a representation of behavior. We just need to determine how. And let's say renter-to-owner ratio. Renter-to-owner ratio is significant as a long-term supply indicator. People will never think of that. Now, let's say you have a high percentage of renters in a suburb and macroeconomic conditions change where interest rates increase. That means obviously those properties that are rented out are owned by investors, yeah? And let's say investors can't hold on to their property for long because of increasing cost. They start disposing those assets. Those assets turn into supply on market, and if it's not met with the appropriate demand, the price stagnates or declines.
Yep.
So you just have to think about every metric in terms of how that will pan out in real life and what will affect. So rarely do I see, you just mentioned it now, but rarely do I see people thinking of renter to owner ratio as a supply indicator.
Oh, it's a very big indicator in my eyes, because on average you don't want to see anything above 35%, and if you can see 10 or 15, you're like, yay, we are playing.
You know, it's interesting. For example, we did a recent presentation about markets that are sensitive to interest rates.
Oh, we'll definitely touch on that.
Yeah, should I not talk about it now?
Actually, let's talk about it now, because I think it's a very interesting topic, because it's slightly different to how the market reacts in general, because affordability changes there slightly.
Absolutely, yeah.
Because for investment, we're looking very often more affordable areas.
Correct.
As from interest rates, when it declines, affordability increases, but it's from and I watched that release. Yeah. It's the better socioeconomic areas that benefit the most.
So first, regarding affordability. Now, and you asked me what are the 5 most important metrics. Affordability will definitely be the top one, and the reason being is because the highest disparity between median income growth and property growth is actually now since 2017. I mean, the gap is huge, which means that it affects individuals' ability to purchase property. And if you don't have individuals buying property, you don't see any price growth. Now, it's not only for investors. Actually, it's more important for owner-occupiers. And owner-occupiers are twice as large purchasing cohort in Australia than compared to investors, you know. So you need to make sure that the area that you're investing in is affordable for investors, you know. For owner-occupiers, because they first start participating in the market. And when you see small increases in price growth, like if you have...
You need both.
Yeah, you need both, but it causes a positive feedback loop. So... owner-occupiers start participating in the market, you see small price growth, and this is when investors start flooding the market, you know. Now, coming back to the interest rate sensitivity, if you, because affordability is so crucial, when interest rates drops, the markets become more affordable. Now, which markets are more reactive and sensitive to the interest rate drop? And what was interesting is usually the higher price markets. When you think about it, it's common sense. So usually markets that are 700K and above are more sensitive to interest rate drops. And what we found is that we did a
why do you think is that? Just to go deeper a little bit on that.
When you think about it, common sense, it's like if in higher price markets, property is more unaffordable. And when interest rates drop, it becomes more affordable. There's a higher sensitivity there, you know. Like in lower price markets, property is already affordable. In most instances, property is already affordable for its residents. Now, lower price markets don't have a good alignment of other metrics, which is why we don't see substantial price growth. But most of the markets that are in 550K and below range, we have the years to own metric, you know, how long it takes for individuals to pay off an asset in a particular area. And most of the 550K and below areas have 30 years to own or less, you know, which means they can pay it off in one lifetime, essentially. But higher price markets, 700, 800K, 900K, they're sitting at 40, 50, 60 years to own, which means that there's a huge friction point there. And when the interest rates drop, there's a relief window. But it's only a window, because what happens usually is that when you see affordability increase, people start purchasing property, and because affordability is also a factor of price growth, you know, so as soon as people start purchasing property, price grows, and then you're back to status quo, or essentially the initial point that you started with, you know. So what we found, and coming back to renter to owner ratio, why I wanted to connect it is, we did a correlation analysis, which is just an algorithm doing its thing, you know, and we wanted to delineate 4 or 5 metrics mostly correlated to price growth and affordability. And we realized that first is the typical price. You know, the higher the price, the more sensitive the market to interest rate drops. The second metric was house to unit ratio, which is interesting. And when you think about it, it makes perfect sense. Now, by the way, you still have to account for higher prices. So these are not siloed out metrics. They're all connected to each other. So if you're in higher price markets, and if you also have markets that have higher house to unit to house ratio, those markets are very sensitive to interest rate drops, in a sense that usually causes a growth spur. And when you think about it, usually in higher price markets, people rent in units.
Because they can't
And there's a
afford it.
higher renter to owner ratio there as well, because they can't afford the houses. And then when interest rates drop, affordability increases, people jump from renting apartments to owning a house. So that's it
You
was.
still need to be mindful, I would think, how many renters are there. But I totally agree.
No, absolutely,
that
and this becomes a timing factor, absolutely. So if you're investing in markets that having a higher renter to owner ratio is a negative thing, and we discussed it because of the supply. Now, this is why it's beautiful to actually organize data in terms of time frames. So let's say we're at the position now where interest rates are dropping. And they will continually, usually business cycles, because business cycles in Australia follow the Fed cycle, which is the US Federal Reserve, yeah? And we see a trickle-down effect in how liquidity is managed across the world. So when we see increase in interest rates, and they all increase it in unison. It's usually the Fed starts first, and then, Bank of England and other banks start to follow, as well as Australia. It's the same in inverse. Like Fed would usually drop interest rates, then it would be Australia, potentially Japan, China, etc., etc. So, what I wanted to talk about there now. So the business cycles are usually 4 years these days because of debt cycles. Now, I don't want to go into details about that, but essentially it's the interest rates that you have to pay on government debt. And they usually work in 4-year cycles. So let's assume that in the next 4 years in Australia, you will see a gradual decrease of interest rates, provided that inflation is also reducing. And if we take a 4-year window and the interest rate started reducing now, if you're investing in markets with a higher, now this might be a bit of a mind twist, but if you're investing in markets with a higher typical price, higher renter to owner ratio and higher house to unit ratio, because those markets are very sensitive to interest rate drops, you need to have in mind that when interest rates start increasing, you might have an increased supply because of the higher renter to owner ratio. So your play can be to be invested in those markets for the next 4 years and then exit, not long term.
I think it depends on the quality of asset you are buying within those markets, because there are limited type of assets that can be sitting within those markets that even after the interest rates go up. It depends, because
we are talking on an aggregated level, suburb level. Absolutely. There is a time lag with different assets. Some assets might still continue to grow year after the 4 years or 2 years after, or maybe grow permanently, or indefinitely. However, nothing grows indefinitely. Everything grows through cycles, and it's also based on comparable sales. So if there are great assets within the area, but sooner or later those assets will be affected by comparable sales. Because if comparable sales are indicating a price drop, it will essentially create a friction point whenever those great assets will grow, but it will start stagnating a bit more,
But so basically, based on your research that you've done, in terms of the interest rates dropping, there were 4 points in terms of...
unit to house ratio, unit to house ratio, school rank, HtAG, socioeconomics, and GPO distance, general post office distance. Now, general post office distance was inverse. So what I mean by inverse, the higher the price, the more sensitive the market to interest rates. The higher the unit to house ratio, the more sensitive the market. The higher the HtAG, the more sensitive the market, or the higher the socioeconomics, yeah? The higher the school rank, the more sensitive the market. However, the lower the distance to the general post office or the capital city, the more sensitive the market. Center. Which means essentially, inner city markets are most sensitive to interest rate changes in terms of a pump or a price growth happening thereafter. Yeah. Because they see an increase in affordability, and then people start piling in until the gap closes, and then it cools off a little.
Because people can afford it.
Yeah, right. So people want to live in inner city areas. Essentially, they can't afford the property in inner city areas. When affordability improves, they start jumping on the ownership wagon. If you want to see my W's are always bad. English is a second language. So they jump onto owning a property, but again, you have a small window of opportunity because it closes thereafter because you see an influx of demand. So yes, I agree. Renter to owner ratio is a negative sign of the area and something to be concerned about. And it does have a high significance. However, in some instances, like in instances of, trying to test market sensitivity for in relation to interest rates, you can invest in markets that have a higher unit to house ratio, renter to owner ratio. However, you have to be mindful of how long you're going to remain in that market. That's what I'm trying to say.
Yeah, no, I agree with
Yeah.
you. But I think it's also because, in terms of, like, for example, if you're talking Melbourne in a city, there are some suburbs, let's say if we're looking even like Brunswick or some other suburbs from inner city, there is a high percentage of renters to owner occupiers. But if you buy an asset which is, it's like a scarcity there. Like if you're buying a land component or like a house, the reality is once they jump, it's still a limited asset, especially if we're looking into some nicer maintained period homes, etc.
Absolutely,
which I believe will hold the value regardless because there's just not enough
No,
for
no,
them.
absolutely. And you know what? I always say to people, when they ask me, is this area A good investment location? I always say in comparison to what? Like we can't talk about an area in an isolated sense because the area's appeal is based on how it performs or what it shows or highlights in comparison to other possible options. So if we're talking about areas that have a high renter to owner ratio, my question would always be, are there any other opportunities that are similar but have a lower renter to owner ratio? So that's the first step that I would do. And then the second step would be looking for that scarcity asset. So it's always in comparison to something else. Nothing is meaningful in isolation.
On this question, I know that you are in the process right now buying an investment property yourself.
No, it's not for ourselves. It's under HtAG.
Under
yeah,
HtAG.
so HtAG is this year we decided to buy aggressively. Yes,
absolutely. So the first investment that you're planning to buy this year, what is the price category?
So we're looking at about the 700K mark, and it's not by accident. We've done research, extensive research, and it shows that the 700K category has the highest probability of doubling in value in 10 years.
Right, awesome.
Yeah.
And if we go back to your 4 questions that we've highlighted in
what
the
will
beginning.
be our answers to those 4 questions?
Yeah, can we please answer those 4?
So now I mentioned to you offline that we are looking at either buying in Melbourne or in Queensland. Now,
I know good buyers agents there.
Sorry?
I know good buyers agents in Melbourne.
Yeah. Okay. Yeah. Let me know who they are. So, and it all depends on the actual answers to those 4 questions. Now, if it's buying in Queensland, the investment timeframe will be more compressed. If it's buying in Melbourne, the investment timeframe will be more extended. Now,
which is?
So, if it's buying in Melbourne, it will be 10 years plus. If it's buying in Queensland, it could potentially be 5, 6, 7 years.
Okay.
Yeah, so we'll compress the time frame more to take advantage of the cycle position where Queensland is in at the moment, generate substantial gains, and then obviously if pen to paper exercise permits and sales and acquisition costs actually provide us a benefit, accounting for that as well, we would sell and buy in a different area. So we still haven't determined whether we want to shorten the investment time frame to allow ourselves to leverage into additional purchases quicker. Or whether we want to extend the time frame and just wait for the area to do its magic. So that's why if I had to answer the questions, it will be, if I'm looking at Queensland and Melbourne, let's say Queensland, the answer to question number 1, what is your budget? Our budget will be between 550 and 650. It wouldn't be 700 because everything above 700 in Queensland does not provide great opportunities. Okay, 7-year time frame, great opportunities. 650, 700 and below has
and you say
more appeal.
It does not provide any great opportunities.
Great opportunity for substantial growth within contextually great. What I mean in comparison to other options.
So the budget that you are considering around 500, 550?
550 to 650 maybe.
550 to 650.
Yeah, that would be the
because
budget in
under 500 is not considered a quality asset.
Yeah, wouldn't be. It doesn't have great indicators to generate that substantial return within the first 7 years, as well as those that are higher price point. It doesn't have great arrangement of metrics which generate above average returns within the 7 years. Queensland, the sweet spot for Queensland, in our view, is between 550 to 650, 680. So, and then answer to question number 2 for Queensland will be how long would you hold on to that asset? It will be about 7 years or thereabouts. Yeah. Now, question number 3, when do you plan to extract equity into the subsequent purchase? We wouldn't extract equity. We just let the compounding do its magic and then sell the asset and then use the proceeds to buy other assets. And then question number 4, what is your risk profile? Risk profile will be low to medium, because it has to be low to medium because your investment time frame is 7 years. So you don't want to invest in areas that are too volatile, like Mackay's, at least for us. I would invest in Mackay if my investment time frame is 3 years.
Sure.
You know, or Gladstone if it's a year and a half.
So which area are you looking at?
So I like particularly Brinsmead and Redlinch in Cairns. I like Cairns more than Townsville. Townsville I don't... Townsville is great, by the way, but if you invested in Townsville a year and a half or 2 years ago, it still has, you know, a couple of years steam, but I think it will subside thereafter. So we want to enter a market that it's right at the cusp of becoming that hotspot. And I like Brinsmead and Redlinch because of its socioeconomics and all of the alignment of all of the short-term, mid-term and semi-long-term indicators. Now, if I'm
I just came back actually from there.
You have?
Yeah.
Me?
I've just been to Redlinch because for my Cairns trip. That was fun.
Yeah, so what do you think about the area?
I think, you know...
considering its price point, so...
Considering its price point, it definitely have potential.
Yeah.
It's definitely have potential. I didn't go there for no reason.
Yeah. I went to Cairns recently as well too. I went to Brinsmead to check it out, and I'm happy with what I'm seeing. So I think it's...
There is different parts to Redlinch though. Different parts to it. You know,
as in to buy which asset you buy within?
No, in terms of different pockets of that.
Oh yeah, absolutely. Absolutely.
Because there is a few.
Like in any other suburb.
Like in any suburb. Like name Turek. Or any most expensive suburbs, they all have great pockets that you don't touch with a stick, and the others that are really worth investing.
So I mean, but to those who are listening again, these two areas, you know.
Let's go back to Melbourne.
Yeah, I will. But I just want to say this. I just want to say that these two areas, they fit a particular strategy and mold. You know, they're not for everyone, and they're not. You know, people shouldn't just rush in and buy there if their strategic plans are different. Now, going to Melbourne would be a long-term buy and hold, simply because Melbourne is It's not an area that is transitioning between a warm spot to a hot spot. It's not close to being a hot spot. For Melbourne to become a hot spot, I think it will take another 3 years. This is what I believe, which is again, see, that's why it's 10 plus, because if I'm buying an asset, I'm waiting for 3 years for those above average returns, I have to extend my time frame to allow for the compounding to take hold.
You know, it's actually like we were also discussing in a lot of our dialogues with the clients that, let's say, you need to think at least 3 years, you know, in terms of just seeing the performance.
Yeah, you were saying that? Yeah, exactly.
But I can tell you one thing, last 2 to 3 weeks,
I was about to say that actually.
Insane.
I was about to say
Melbourne.
that.
Insane.
So I was about to say that Melbourne, interestingly enough, is from the on the ground activity, and you know that in our mastermind, people usually post from the ground activity about what they're seeing in open homes and how it's behaving. You see in some areas that we actually particularly like as well. You see, 40 people showing up for an open house.
I can tell you, people buying at the moment properties sight unseen.
Yes, especially Sydney buyers agents. Yeah,
Sydney, but actually, I find you will be surprised. Yes, there are some Sydney buyers agents, but majority are owner occupiers fighting in a FOMO for the price increase that is, they're anticipating.
So imagine when interest rates drop.
No, I can tell you, it's for the first time I could see in a long time, like in the last 3 years, for the first time I'm seeing owner-occupiers buying properties, no building impact, no finance, nothing. People just making an offer after the first open home. Like it was very normal in Queensland, for 2 years straight. Mm-hmm. It was unexpected. First open home on Saturday at 10 o'clock. By 4 o'clock it's sold. You need to submit your offer. For us in Melbourne, it's like 4 weeks campaign. All great. Now it's very different. And I don't know, to be honest, I didn't anticipate it happening so fast, but the last 3 weeks I'm observing the owner occupiers and what they're doing, and it made me wonder how quickly actually we'll get there.
Yeah, we
change.
We actually anticipated Melbourne movements, honestly, and this is going to sound egotistic, but to the month. We did a presentation. Alex and I did a presentation on what is the next hotspot. I think in was it April 2003 or April 2004? I think it was 2004. I get confused a little bit because I remember at the time Perth was the flavour of the year, month, decade.
We'll touch on that maybe later if we have time.
And what was interesting about that presentation, because it came at a time where everyone was so obsessed with Perth that we caused a witch hunt, essentially, you know. We had to go on 100 rounds boxing match with everyone on social media. And we said that Melbourne is the next hotspot for certain price points, you know. And the data was screaming that it will be. And I remember, and I even have screenshots of my analysis.
I think it's still screaming the same thing.
Yeah, absolutely, absolutely. And we have screenshots of analysis that I've done in certain areas like Karim Downs and some other suburbs. And I said, like, it's definitely going to be a great investment opportunity. That was 8 or 9 months ago when I did the Karim Downs analysis. So it's playing out as we've thought. One thing that's different is the actual level of interest that we anticipated. So we didn't anticipate that much interest. Considering there's 30 people bidding for the same house, which means that there is a bit of a lag in pricing. So, and this is beautiful because you see an opportunity. There's a lag. Melbourne is showing on an aggregated level 0% growth in the last year, you know?
It's actually like you look at depending on a data source, like we are all in minus. But
So that's why I said zero, between -5 to +3, you know?
But you know, the thing is that people don't see probably behind the scenes. There is obviously the sentiment, like what I feel on the ground, the sentiment is changing. And sometimes, you know, it's just a little drop in interest rates can impact significant sentiment change around Melbourne market, despite all the other political issues that we have in terms of how difficult it is for investors.
Victoria was I think Victoria was top 10 suburbs in that list that we generated from markets most sensitive to interest rate changes. I think Victoria had 8 in the top 10.
We've just generated a list of top, top suburbs, let's say up to 1 million.
Yep.
5 of them.
Yeah, absolutely. I mean, when you think, it makes sense though, you know, because it's very affordable. It's close to the city. Like that's just a rough general view, but there are many other indicators that just pinpoint that's the case.
But we didn't have the best 3 years here as well, so I think that also plays a role.
Yeah, and I see
other parts of the world.
It was sort of. But that's the thing, you know, cooling off provides opportunity. Everything is cyclical. You know, people think that just because today something is happening, it's doom and gloom. It's never going to change. That's why successful property investors can anticipate market movements. So they don't care. They don't get swayed by the discourse online, you know. Now, the only thing that's detracting investors from Melbourne would be a bit lower yields, but that's the cost of business.
I mean, there are a few more things in my view, because there's obviously land tax, there's a higher stamp duty. So we're not making it easy.
No, absolutely. But again, as I say, cost of business. Absolutely. Think about that as cost of business.
100%.
You know,
we're buying in Melbourne. No
exactly.
problem.
You know, and if you know what's going to be funny? It's going to be funny for people who are thinking about all of these negatives, and then 2 years later, there's Melbourne seeing 60% growth. They're like, why didn't I? You know, and signs are everywhere. It happens all the time. Now, if you want higher yields, go to Queensland. But, you know, deal with lower yields, but you have a phenomenal opportunity to buy an asset that's 650K or 700K, which might be 900 in the next couple of years.
And to be honest now...
Not a couple of years, 4 or 5 years.
To be honest, right now, high yields in Queensland will be in the places where you're probably not as excited to buy.
Well, let's use one example. Now, you know, Townsville at the moment, Townsville has seen... on average, I would say 25 to 30% growth in the last year, and the gross yields are about 5%. Great yields. However, if you're after a growth play, Townsville has potentially, so you're buying at the peak of a particular hotspot, which means that it's only down from now. Now, down doesn't mean no growth. Down from a 30% growth down is 25. You're also generating 25% in the next year, but it will subside after 2 years. And if you're buying at the peak, this is why I say timing is as important as time in the market, but not for the reasons most people think. Timing is important because you want to time your entry at a particular cycle in the market, position within a cycle.
How would you pick it up?
Simple, it's just supply and demand.
But let's say, for example, for those who are maybe new to property market,
How would I pick a market that's at its peak?
it just, let's say, for example, it's too late. When
When-
people like say, oh, Townsville or Cairns or Perth.
Put it this way: when you're already
or Queensland,
speaking about
when would you consider it to be too late?
Yeah. So, general common sense: when people are already talking about it, it's too late. Now they're talking about Melbourne. It's not too late for Melbourne, but you're going to struggle to find an asset. Now let me just explain what I mean about when it's already a hotspot. It's too late. When you're seeing, for example, an area having severe supply scarcity, severely increasing demand, and for example, vacancy rates are increasing dramatically. That means oversaturation with investors. Think about it, because that's just one indicator. Because think about it, people are coming, investors are buying, and there's not enough rental demand for that asset. That's why vacancy rates are substantially increasing both short-term and long-term. That's one tell sign. Another tell sign is an established friction with unaffordability. Let's say you have a market, Perth is a good example. You have a market that still has a reducing supply and increasing demand. However, affordability in some markets are sitting at a level that it's unaffordable for the owner-occupiers. So you have a diminishing participation of owner-occupiers in a particular market. Another tell sign would be lower socioeconomics, substantially high prices. I'm going to cause another witch hunt, but Brumbury as an example. Brumbury is 750K in typical value with an ERSAT or socioeconomic score of 1 out of 10. I mean, there's no steam left in that market to double in value. Do you know what is the percentage? And I've, again, did the research on this extensively. The percentage of an area to double in value from 700K mark with an ERSAT score of 1 and 2, as in socioeconomically,
It will be low, I would assume.
is 0.35%. So it's less than 1%. So you already have a friction point and people are still talking about Brumbury. So Brumbury has, when I say unaffordability, so unaffordability does not mean it's at an unaffordable range. It can mean substantially increasing unaffordability. It can still be at an affordable range, but if the unaffordability, the levels of unaffordability have increased dramatically in the last 2 years, the mindsets are reshaping of mindsets of individuals within a particular suburb have been affected. Think about it this way. I came to Australia in 2000. I could fill a shopping trolley with $20 in Coles in year 2000. Now it takes me $200. Yeah? So my behavior is going to change. I'm going to go to IGA, I'm going to shop at a market. So think about residents that are living in a particular suburb that had, within the last 2 years, experienced phenomenal increases in unaffordability. They're gonna change their behavior and their purchasing will diminish. So it's not only being at a yet right now unaffordable range, but it's also the rate of change in affordability that's important. So yeah, vacancy rates, rate of change in affordability, low socioeconomics, high price points, those are all, and I did a presentation on this, those are all concerned, like tell signs about that can inform people to stay away from an area.
Okay, absolutely. And, from a perspective of, we just...
Does that make sense what I just said?
It does me. I hope it does to our audience. But in summary, basically, it just has to be affordable for owner-occupiers in that particular suburb in order for it to create a decent competition and generate the growth. And if it's unaffordable for locals, then unfortunately...
There's a friction point.
That double-digit growth that you're hoping for is not going to come.
No. They're 2 times larger borrowing cohort than investors. So you're eliminating 2/3 of the market.
Yeah, we had that conversation before, right? About what is the best investment? It's something that owner-occupiers would love to run.
You said that to me. You were the first person that said that to me, and I keep on using that, and I keep on not mentioning your name specifically, but I say a lady told me this, and it's like I knew it, but you framed it so well. The best investment property is one desired by owner-occupiers. That should tell you everything.
Yeah, and then to be honest, let's say when we grow through a lot of data with our clients, investor clients, and I said to them, this is what is important, this is what is important, this is how they relate. I said, but at the same time, when I'm presenting your property, if it doesn't make sense for any local family, that it probably doesn't make sense. In terms of, I said, like the overarching...
But let's say why? Because that local family has to rent out that asset.
Absolutely, but
and
it's
buy
also,
it later, which is what's going to make a growing value. You know what I mean?
Yeah, but also, that concept of it's a very common theme area among, especially people when trying to chase the best asset. And they would say, I would buy the worst house on the best street. And I often sit there and the first thing they say, let's revisit that. Because the reality is people on that street, by default, can afford a better home and would always prefer a better home. So your house will always be less desirable asset by default. So I would say, in my view, if you would go as they call very often like bridesmaid suburb, next door, and buy actually a home that is typical for any typical family within that suburb, you are on the money in many cases. Of course, you need to be careful with your due diligence. You need to know because, as I said, with any suburbs, there are pockets within pockets. There are streets within those pockets, and you need to be aware that, to be honest, like for me, property investment is not a rocket science in a way, because it's just there's a lot of common sense that come with it, but you just need to be attentive to detail to make sure that you buy an asset that has decent flow plan. You understand what those renovations might cost, because very often people's like, oh, this is a huge, awesome land. And I'm like, yeah, but it's a tiny, really, really bad quality house on it. And how much experience have you had as a developer?
I was just about to chip that in. Yeah, exactly. If you're going to renovate and develop, okay, no problem. But, it's a completely different strategy again.
Absolutely. And I know that you also have that strategy, like when people buy, let's say, 3-bed home and
they convert it to
3-bedroom home,
bed.
and there's a disparity between 3 and 4 bedder, for example, when you can add it. But I also see a lot of people not realizing that, let's say, the building cost in Australia increased by 40% in 5 years.
Yeah, so you need 50, 60K to add a bedroom, external bedroom.
So, but you need to also, in ideal world, know what you're doing.
Absolutely.
Because
so
at the moment, the moment there are people that can't even make a bathroom for that much money.
Yeah, but everyone is watching The Block these days. Is it still around? The Block?
Yeah, I think so.
So everyone is an expert in. I come from the construction background. I used to be an estimator.
I'm not against that strategy as long as you know what you're doing.
No, absolutely. And again, if you're going to hire someone to do it for you, you have to take into account those costs as well. So coming back to your worst house on the best street, well, that's a good option if it's the only one left.
True, but
not bridesmaid suburb is better. What I'm trying to say is that why pick? Again, it's comparison. Why pick the worst house on the best street? Why don't you pick a better house on the best street?
Because it's only if you can afford it, right? But that's where you need to work within your budget.
But what is the disparity anywhere within a street when you really think about it?
Disparity can be significant if you
20%.
Of course, but it's more about desirability, right? For example, we had a client that approached me just early this week, and they've approached us only just to do the due diligence and bid. To be honest, they originally just wanted us to bid at the auction.
Yeah.
But we don't do it. Like, we just don't bid. We don't bid unless we checked, because it's also the reputation thing.
Yeah. Unless you checked, sorry.
I need to do due diligence
on the property.
Yeah, because I don't want to go and just bid for the sake of bidding. That's not the business.
Can I ask you a question? I know it's your show, but can I ask you a question?
Sure.
What is what is the checklist for due diligence? Some of the crucial points. Let's go with 5.
Let's go with 5. Let's just use that example, right? I went to the site to have a look at the location, right? Because on the paper it looked great in terms of big block, good layout house. And when you quickly have a look at it, you're like, actually, not bad.
It makes sense,
It makes sense. But then there are a few, like when I arrived, instant red flag. High voltage power lines can be seen from the entrance of the home. That is something that can...
What's the issue with that?
A lot of people will find it very intimidating, effect on their health, If like there's like basically.
Well, I know what the issue. I know in my view. I just thought you have something.
Of course. But the biggest issue is that it can basically jeopardize the desirability of the asset,
Absolutely.
especially
Again.
in the cool market like it is today.
Correct.
Because the reality is that in a hot market, everything sells. We both know it. But even with my owner-occupier clients, like we work a lot with investors, but when my owner-occupiers, and this was an owner-occupier, I said, listen, regardless, you need to think about resell. You need to think about exit strategy. It doesn't matter you're buying it as a forever home, you need to think about exit strategy. That will be an issue for your exit strategy if it's a cool market, always. Because people become more fussy, people, restricted on money.
It's a buyer's market.
They will not buy this house. Then the other problem is that, let's say they hardly had any time to do building and pest inspection. And I was like, we have to do it, especially when you go through the property. And we organize quickly building and pest just to have a look from inside. And that's easily $50K upfront because there was a lot of things going on with the garage falling down. So I can't stress it enough how important it is to do the contract review and the building and pest. Like two of our, one our client and one kind of semi-client, if you like, almost bought a dud purely by not doing basic checks, contract and building and pest inspection. Because you can have the most beautiful house, but if you have a termites in there that you haven't spotted,
right, 50K, you need to,
No, but 50K is nothing in comparison if you have termites in your property, and it can be in the roof, in the stumps, it can be
you
everywhere.
got to strip everything, it's like,
right? So this is two things that needed to be done. Then the other thing, because they wanted to build a forever home for themselves, they obviously wanted to put money into it. And I was like, well, the challenge with this house, because of that high power voltage line, you can overcapitalize on this house if you will make it super duper pretty.
That's a great point,
Right? So that was another, to be honest, let's say that property was advertised 135 to 145. And I know that they've called to my sister to say, how do we bid? Should we give them 145 or 14? When we run the numbers, I said, listen, for 13 to 135, it's pretty much a land value. So I can't say that at this level it's terrible, because it probably can't get lower than that. Just to give you a perspective, in 2016, in 2016, the same property sold for 1.1.
2016, okay.
Yep,
10
9
years
years.
ago.
So for 9 years, somebody tolerated negative gearing most likely on that property, paid huge mortgage, probably sacrificed the lifestyle, and they can't even break even right now. They struggle to break even with all the stamp duties, fees, etc.
Do you think it's also the area in question? Or
No, the area, actually, that pocket is not a bad pocket. If that house would be just even 4 houses away from there, I might have a different,
perception about it,
or different recommendation.
Yeah.
But with that one, was just that I said, listen, see, that's a clear example of in the cool market as we are now. Still, it's warming up now. But people are fussy, right? And the reason why we're in mine is because many investors are selling their properties. So most of their assets are just not great. There is a limited number of quality assets. Because people in Melbourne right now don't sell unless they have to. It's not like you go, let's sell, I get the best money. That's not the case. Many people sitting on their hands waiting for the interest rate to come down. That's why most of the assets that's showing it's been sitting on the market forever. I was like, of course, because it's terrible. And many assets on the Melbourne market right now are terrible. And as a result, that's why the results there, because good quality assets, and I can tell you, I don't feel like it's easy to buy Melbourne. It's not easy because quality assets are always hard to buy. And I always have a competition on the market if I am going after an asset, because you're buying a quality asset. People are not stupid. People will fight for it. And that's where you always compete with someone, unless you've managed to buy it pre-market or off-market. But again, you need to understand that off-markets are not...
I don't like that term.
Off-market are...
Personally, I don't like it.
I mean, for me... Personally,
I don't even know what it means. Well, I know what it means.
Off-market, it's like when a vendor have, in ideal world for the buyer, they have a situation when they're desperate to sell and terms are more important than the purchase
That's right,
price.
but sometimes the desperation can come from the bad nature of the asset.
That's what I wanted to say. Like when I talk to my clients very often, and I know that buyers agencies very often sold like we deal like 80% off market, etc.
Yeah, that's why I dislike it, because
I can say you the reality is it's a very, very small percentage of off markets that I really like and buy. In most cases, I say no. And the reality is because very often it's an asset that will not sell well on the open market in any way, or it's an opportunistic price. When the vendor sits there and says, if you'll sell me for this price, I'll sell it. Like, why wouldn't they?
Yeah.
Let's say if the market most likely sits at around 1.5 million, but if you can sell it to me for 155 off market, I'll sell it.
Yeah, see, 100%. People don't, again, go into the minds of that individual that's selling. Do you think that the seller would want, just out of the blue, to sell their property for less?
Yeah, because it's a buyer's agent.
Well, you know what I mean? Like, why would they want to...
I know what you mean, because
why
I
would
deal
they want
with
to
it
sell it
every
for?
day.
They want to sell it for more. If they're selling it for less, there's a good reason why they're doing it. So you better inquire about that reason, which is why the whole notion of off-market, and that's how people are positioning their services. We're finding off-market... Please.
I mean, like we always look for off markets, but very often it's the pre-markets.
But you do the due diligence
interested.
extensively in order to vet, and you said it, 8 out of 10 is not worth it.
I would say 9 out of 10.
Yeah.
I would say 9 out of 10. Like sometimes you meet those off markets that are just brilliant, but unfortunately for the seller, it's because they in the corner for whatever reason it is. Like maybe it's a drastic divorce, or somebody needs urgently move into state.
Somebody died,
So there is unfortunate situations when you can negotiate a good price as long as you give them what they want, whether it's 6 months settlement, whether it's 30 days settlement, whatever what works for them. To make it happen. But in many cases, let's say seller, it's the biggest asset in their life. Why would they sell it for bargain off market? Especially when they hired a sales agent to protect their best interest.
Exactly.
That they will sell it to the buyer's agent just because they have some kind of relationship. It's just if you'll think about it, if you'll step back and think about it logically, it just doesn't make sense.
Exactly.
Which it doesn't.
Yeah.
But that's why, so just going back to that, we've, like in my role, like I can't tell the clients necessarily buy or not buy. But I provide all the information that we can dig out, and I say, like, based on that, I believe there might be issues with this and that.
Yeah, of course.
What do you reckon? And this client voted, says, thank you very much. We actually don't want to buy it anymore, but we'd rather you to help us.
I say the same thing. We're digressing a little, but I say the same thing to when buyers agents are promoting an area without giving any cons away. I always say be cautious of that, as in cons, as in some negatives, because every area has pros and cons.
Oh, 100%.
And when you're speaking about an area that it's this golden nugget that you just stumbled upon and nobody else has seen but you, red flags.
To be honest, like when I speak to my clients, I always tell them, please don't be surprised. There's always something negative I have to say about a property.
Yeah,
but it's not always a deal breaker. But it's just something that you need to understand and be aware of.
Yeah.
Although, last year I've actually bought the property 10 out of 10. I could not say anything. It actually was for the first time for me when I was looking at the asset and thinking, oh my God, I love this property. There was just nothing.
Yeah,
like,
but you come
it was just by the book as like ideal. Perfect? Nothing. But that's rather rare.
It's very rare, exactly.
There's always something.
Like we talked about renter to owner ratio. It's a bad thing, but then you put it in context and say, okay, it might affect your whole time frame, you might do this, you might do that. You need to always paint the full picture and give the pros and cons. And I do the same. I actually do the same. It's just that I do the same for areas and understanding the appeals of areas. I always give pros and cons, but I say for you and your strategy, this might not be as significant as for others, So yeah, I agree.
Just because we're getting closer to the time, but
we can talk
what
for
would
hours.
be yes, we can. What would be the maybe one golden nugget or advice that you would give to the first time investor who really, really wants to start investing but don't know where to start, especially when it comes to data, to get better at it? Outside of just joining your obviously mastermind,
the standard spiel.
I mean, you have a great platform there for sure. And
not to promote the product. I think the best thing like in anything else, again, it's common sense to educate themselves, to understand. Like, it's hard for an individual that starts off without having an understanding, like let's say a blank slate, you know. They have to have an interest in property. That interest will drive curiosity. That curiosity will drive desire for information. That desire for information would lead an individual to a position where they have conflicting information or views, which they need to unpack. So it's like a learning process, you know. I think the worst thing, I don't know what the best thing, the worst thing they could do is listen to people online. Let's say even including me, you know. Like, don't listen to people, try to understand. And if you are listening to someone, try to look for the why. You know, why, try to understand everything, try to understand why, try to unpack it, try to be critical about every piece of information. Now, being critical to the point where, you know, you can't convince yourself and others is a bad thing, paralysis analysis. But I think educating themselves, because I guess the main reason, and I'm answering in a roundabout way because I don't have a coherent answer. My coherent answer is education, but then I can understand that some people will say, okay, where do I start? But I think
all right, how about that? Where do they start if they want to learn about data with HtAG? How do they start?
Well, they would subscribe, and I mean, there's an onboarding process. They will subscribe, they'll have access to the platform, and then they do the mini courses that teaches them how to lay out the data, understand their circumstance, all of that, you know. Now, I always say this, and, you know, there's this misconception in the industry. The buyer's agents are necessary. You know, so you can understand how to layer data and how to layer information. You can understand which suburb is the best for you, but you might not have the time, execution skills, understanding what to look at. You know, power lines. I won't even look up. You know, they're like all of these other things that buyers agents bring to the table. If I'm talking about purely suburb selection, from an investor point of view, it's understanding your circumstance and how that informs your research thesis, what's significant, what's not. And in HtAG, you will subscribe, you'll do the mini courses, and in Mastermind, I personally coach people on how to do that. But if I decouple that from us, from HtAG, it's essentially the education process. Understand what vacancy rates are. What do they represent? What do they affect? They affect the yield. The lower the vacancy rates, the higher the rents, the higher the yield. Like, understand these connections. What is the days on, you know, a lot of people say, there's a lot of infrastructure investment, or the employment is high within a particular suburb. That means the property will grow. Well, why are you looking at macroeconomic factors? You don't know how long they will trickle down to the purchasing patterns. Look at the days on market. What does it reflect? Lowering days on market means increasing demand. Means that property is getting bought quicker and quicker within a particular market, which is an indication of sentiment and appeal and X, Y, Z, you know. So understand what each metric represents in terms of behavior on the ground. When you understand that, you can connect that into a story. When you can connect it into a story, nobody can bullshit to you. So, for lack of a better word.
Yeah, no, absolutely. And, you know, like at the end of every episode, I want to ask people that, what is the book that built you?
Yeah, you asked me that before. It's hard, you know, like, I read widely, but I read mainly philosophy books, and not because I'm pretentious. I just don't like novels, apart from Dostoevsky, essentially. But
you know, like, because obviously people that listen to this podcast, they, like, obviously the decision-making mindset and so forth is critical in any wealth creation journey regardless. But what do you think would be that had impact on you and helped you to be better at, let's say, investing and decision-making out of the book? Is there any book that influenced you in some way?
Yeah, so I love, I mean, as I said, I love philosophy because, again, philosophy makes me, forces me to think about notions in a critical way and try to look at it from different angles. It's all about, you know, thinking critically about things. That's what's missing. That's what's missing in most of because of the Instagram culture. And I have nothing against Instagram. It's like a surface representation of things that's driving most of the decision making these days. There's no thinking about essence. What's behind it? What's underneath? What's below? Where's the depth? You know. So I guess one of the books that really shaped my thinking, and I was using it in my when I was getting my PhD as the main source of information, was Matija HtAG's Being in Time. It's a book about phenomenology and essentially the construction of the world through language and linguistics. It's a hard book to read. It's not your Sunday reading material. Like I remember when I was reading it, the first 100 pages, I did not understand one word, honestly. But I was persistent. Then I had a light bulb moment. Like essentially, it was like a flash. Now I know, because the
for migraine, switch to audiobooks. It worked for me.
Nah, you can't read this in an audiobook.
Yeah,
you can't listen to it.
All
You
right.
can't. It's too heavy. Especially if you're driving, you're gonna have a car accident.
I found the heavy books are going better for me in audio format.
Oh, really? Because I need to come back. I need to reread the paragraph. I need to reread the paragraph. It takes a long time, and then once the penny drops, it's a really good book. But I mainly resonate to psychology, philosophy book. I love Carl Jung, so any of his works I love. But essentially anything that really makes me question. I guess the most important thing that helped me in building HtAG, building a business and everything is like trying to question all of my assumptions, question everything. Now there is a negative side to that because you can go insane, but no, you can't really. Like you can really dig a hole and there's no end, yeah. But it's beautiful because you really start looking at things from multiple angles, and I think reading widely as well is important. If we're talking about books, you read many different. Like if you're in property, don't read about property books. But just read property. That's crazy. Like I remember one of my, with tie for time, but I remember my supervisor when I was doing my PhD said, if you're doing a PhD in psychology, read about mechanics.
It definitely widens the angles.
Exactly, because then what is happening? Do you know how many insights and how many ideas about building business I got from? Kobe Bryant said, the basketball player said, when you know what you're looking for, the entire world is a library. It's a beautiful statement. I know exactly what he means, because you can apply things from quantum mechanics or from, how to build an airplane, and you can apply it to property. You can apply it to how do you build a podcast, you know what I mean? Or how do you do this? So it's like reading widely, looking at things from many different angles. Obviously, reading books is hard, so it has to be interesting to you to actually finish the book. But if I had to reduce it to one, it would be HtAG as Being in Time. But there's other great books. Sartre, Jean-Paul Sartre, I can't pronounce his surname. Being in Nothing is another one. Jung is also great. But yes, but again, see, I'm in data, I'm in property, but I don't read things properly. I don't read property-related things. I don't care about it because it numbs my mind. Because when you're siloed out and thinking about one subject in one particular way, there's no creativity. So in order for you to have creativity, you got to introduce these different concepts and notions that are not related to the field and actually make connections.
I agree with you, and I think it comes not only to books, but also people that you are talking to and people that you surround yourself with, things that you do. Because when you connect with people from such a diverse, parts of life and professions, you're sometimes surprised how much you learn from them, even about property. Because when you're like, if you look at it and you think, oh my God, that is so relevant. Yeah,
see, it's important. So I agree completely. Like a lot of the things that I learned about property and about trend analysis, about pattern recognition in property was from a hedge fund manager called Raoul Pal, who was a Goldman Sachs executive. Now, he's talking about shares and he's talking about macroeconomics and business cycles and all of that. But I was listening and it was very complex initially. Like I didn't know what it was talking about, but I just persevered. And then it sort of clicked, and you can apply that to anything. So you gotta, But again, interacting with other people, there are some red flags. For example, whoever doesn't like Novak Djokovic, I don't want to socialize with them at all. I'm kidding. But I'm saying interacting with others and absorbing information from others requires you to really drop your ego. So there's like self-work that needs to be done to actually hear what the other person is saying from their eyes, from their point of view. And if you can't drop your ego, you can't actually hear, so you sort of get into the defensive mode. So there's a bit of self-work that needs to be done before you interact with others and can absorb information from them. And you have to be willing to disagree with someone. But yeah, absolutely that as well. It's challenging always. It's just, I'm never content with status quo. Like I just always need to. It's a bit of an obsession, You always need to what's new, what can I do better?
That's why actually, just to finish it off, I think you guys when we've met I think first time we've met in September 23, when we just chat on
Yeah,
the
yeah.
phone. And what I loved about you and what you guys are building is that you truly listen. Like in terms of you're not just saying, oh, my way or highway. You actually continue. And I do remember talking about your platform with someone else in the industry. And I said, listen, I'm very interested in what guys are building with HtAG because I'm fascinated because I saw how you've implemented, do you remember that school score that we've talked about and so forth? And I said, the reality is that what they will grow. In my view, I think they will grow and they will outperform some other data providers purely because you constantly change and take the feedback on board.
Absolutely.
And you twist it. And that's, I think, where your power lies, and that's where you are right now, because I can certainly see this huge growth in in the following, in people that can see value in that. And I think it's a lot to do with the fact that you continuously improve. You continuously challenge the way you do things, and I think that's where their power lies. So please continue doing what you're doing, because it's
don't be too harsh. Don't be too harsh. I'm sensitive. I'm a soft
that's
soul.
okay,
I'm a soft soul, but I will take your feedback on board.
I'm soft on most sides, but no. I've been gentle.
No, you have. And by the way, the school score, you're right. We've spoken about that when.
Yeah,
no, absolutely. Yeah, we will, and thank you. Yeah, I mean, I'm not. Yeah, 30% of the features that we have came from people like yourself.
Yeah, and it certainly helps because the thing is that I think the goal is for everyone just to get the best service to our clients and give the best insights and have the best insights. And you guys been certainly a crucial part in the journeys of our clients as well. So thank you for that.
Yeah, thanks.
And thank you for joining me on this podcast. It's super
exciting.
exciting.
I love it. I can go for another 2 hours if you like.
Thank you.
Cheers. Thanks for inviting me.